Hello, good evening, everyone. This is Zach here from Sifu. So together with me today, we have another section with Dato you to talk about special topic. I think it's a hot topic for today. Okay, because mostly today tech and the semiconductor stock is having a little bit of movement. Okay, now before I start, again, just a very quick disclaimer over here. Do remember this section here? We are not doing any buy and sell call. So if you want to trade any stock based on discussion in this section over here, make sure you go on trading plan. If not, get advice from professional. Again, another thing, before I pass to Dato you to start our section, if you are here with me, please help me to click the like buttons for me. Help me to share this out. And of course, you're always free to ask, question in the comments below, so that probably we can answer you in this section here. So without further ado, I will pass the floor to Dato to start our section, to start this section over here. Dato, pass over to you.
All right. Good evening. Before I start, just let me give you some background. For those of you who have been listening to the podcast over a couple of weeks, you will notice that I always talk about fundamental analysis, which boils down to two things. First, of course, determining that whether the company is sound, and then secondly, looking at whether the business value is reflected in the market price or the market price has gone above the business value. Okay. Now, I have a very simple way of assessing whether the business is fundamentally sound. Okay. Now, we can look at all our metrics and so on, but at the end of the day, there are only two things I look for. One is the current performance better than what he has done in the past? So if the trend is positive, then it ticks one box. Then the other thing I check is, is business performance compared to the peers better than the peers? If they're not better than peers, they also fail. So when I say a company is fundamentally sound, it must be because it is doing better than what it did in the past. You can see uptrends, a lot of things it's doing. And then secondly, compared to the peers, it is actually above average performance. Only when it ticks these two boxes do I consider it fundamentally sound. Okay? It's a simple way to check. So as you will notice, in a lot of my analysis, I look at the industry trends because that gives me a gauge, to assess whether the company is doing better than the industry. And then secondly, I look at the past 10 years of records to see whether it is on an uptrend or is downtrend. Again, these two reflects the way I look at the business. Now, to come back to the semiconductor industry, to be transparent, I've invested in a few of these counters over the past 20 years. There are one or two I'm still holding, okay? Quite a number I've already exited, and I think the price is probably overvalued. Now, what I like to do is I will share with you what I look at when I look at this sector, okay? And then today I will dive into two stocks, Globetronics and Inari, okay? Now, the semiconductor sector, if you look at the Malaysian semiconductor industry, it is actually quite big because it accounts for almost 13% of the global semiconductor testing and packaging part. Okay? Not the chip manufacturing, but the testing of the chips after they're manufactured. Okay? The Malaysian companies actually has a big share of that business. And the strength of the Bursa companies is actually in what I call the OSAT, stands for the outsourced assembly and testing services, and then the EMS is of course the electronic manufacturing services. So basically, we are third-party assemblers and manufacturers. So a lot of the companies don't really develop the products. So we are not Broadcom, we are not Intel. Okay, we are maybe a much smaller scale of TMSC, if you think of it properly. The Malaysian semiconductor industry, of course, is dominated by the MNCs. And the Bursa companies that you see are the local companies that grew up over the years to support the MNCs. And as the multinational semiconductor industry expanded and so on, the locals expanded and did well. So today, I think if you look at what's happening in the semiconductor industry in the West, okay, forget about China, because of AI, there is a big boom in terms of the semiconductor sector. And because of that drive, those companies in Malaysia that does the services for them, that does the testing and so on, experiencing what I say, good business now. The advantage here, of course, is that the Trump administration has exempted the semiconductor sector, not just the semiconductor, even the computers and smartphones and so on, those are actually exempted from the tariff. So this is about the only sector which is actually not affected by the Trump tariff. So it's business as usual. And what it means from an analytical point of view is that if you look at the past 10 years performance and it's going up, there are no disruption trend by tariff over that trend line, okay? Which is much more better picture than what I could say about the furniture sector, for example. Okay. Now, when you look at the semiconductor sector, I classify them into 4 areas. You, of course, have the people, what I call the components, the chip components and the optoelectronic components manufacturer. Okay, and these are companies like Globetronics, D&O Green, and even the GHM. Okay, and then there are those that does the testing and assembly for the multinationals. Okay, people like Unisem, MPI, KSM, and Inari. And then, of course, you have people who actually manufactures equipment and automation machinery to serve the semiconductor sectors. Okay, so basically the Malaysian semiconductor sectors, people like Vitrox, Frontcran. And then you have KASIC is about the only design company that I can think of in the Malaysian sense. And then Turia is actually has a Singapore operations doing plating for the I think it's the plating the chips for the semiconductor sector. Okay. So when I look at the semiconductor, I will focus basically on the components and the test assembly. Okay, because Globetronics come from there, Inari come from there. Okay, but to give you a sense of how the overall industry is doing, I will look at there's about 10, 12 companies in this sector. Okay, and if you look at the size, the assemblers, okay, Inari, MPI, Unisem, they have the biggest revenue and assets. And the component manufacturers, have relatively smaller revenue and asset base. Okay. And I think when you look at how the people who do the testing and assembly does and so on, you can understand why the revenue is up, because basically they are just outsourcing. So they are just outsourced producer on behalf of basically the US companies. Now, the industry, when you look and stand back at the industry over the past decade, you find out that it is a growing industry. Okay, it is almost a very high single-digit growth rate, 8-9% compounded annual growth rate for the past decade. Okay. And together with the revenue growth, there's some profit growth, but not so good. And you can see that the profit has a peak in around 2021, 2022. This is following the COVID supply chain disruption and so on. Because of that, prices shot up, not because of volume. Okay, it was basically a price-driven supply chain spike. Okay, but when the supply chain got resolved, another thing went down again. Now, the strange thing is that when you look at the returns, and I'll show you the profit trend again, the profit trend is up, but the return trend is down. Okay, so if you are investing in this company, don't get excited, because whenever the company announces profits, you don't get excited, because one of the feature of the sector is that this is a sector that requires constant investment. And if you look at what has happened over the past decade, okay, the amount of capital required to continue to invest in the business is growing at a much faster rate than the profit growth. That's the reason why the return on equity is coming down. Okay, it's a profitable industry, but it is the one that requires new capital. I tell you this story. About 10 years ago, I think, or 10 to 8 years ago, there was one of these companies that I invested in, and it had tons of cash. So I wrote to the chairman and I said, look, based on my analysis, you got so much cash. Why don't you just give back the cash to your dividend is only 5%. You got so much cash. Why don't you return more cash to the shareholders? And they wrote back and said that they are in an industry where they cannot forecast the cash requirements because of the capex requirements. So sometimes they have to invest a lot, and the cash comes in handy. So although they have something like 40 to 50% of their total assets in cash, they were not going to distribute back to the shareholders. Okay, they were keeping it as a rainy day. So you can imagine it is the feature of the industry. Okay, it is a capital intensive. It is a constant renewal, and one of the challenges is because of this feature, what I call the capital efficiency measured by gross profit over total assets is a declining trend. Okay, I have not seen it going up continuously. I've been looking at this sector since 2001. Okay, and it's a long-term downtrend. It's a very sad thing. Okay, now it is a challenge industry, because when you look at it, the gross profit margin, okay, 10 years ago was 40%. Today it is 30%. The trend is down. Okay, because of labor costs, input costs, and the fixed overhead, the selling costs, and so on, keep rising as well. So margins are being squeezed. Okay, it is a growing industry, but it is an industry where margins are being squeezed. And the only good sign is that the debt level is coming down. Okay, so over the years, the company is borrowing less. They generate enough money pay off the debts, reduce the debts. Okay, and the conclusion is what I said earlier. Okay, it is an industry that we can grow revenue, but to be profitable or capital efficient, growth is going to be much harder. Okay? And the main reasons for this is, and if I quote some of the companies in there, capital demands are relentless because we are serving the multinationals. We don't have bargaining power, so pricing power is limited. Okay, and in the Malaysian context, getting the engineers and so on is getting much harder. Okay, getting cheaper engineers, I think it's not. It's getting harder. Okay, and as I will share with you later on, this is an industry where because they are serving, you are serving multinationals and so on. There's a very strong customer concentration. So you bet your business on one or two customers. So if the customers do well, you do well. If the customers do badly, then you're in trouble. So it is a tough sector. Now let's look at Inari and Globetronics a bit more in detail, and I will refer to the fundamental mapper, where this is an app where we classify companies based on the business performance. So the horizontal axis shows the business performance. The right side means very good performance. The left side, relatively bad performance. The top side is the investment risk. So the higher up it is, the more risky. The lower it is, the less investment risk. So when you look at Inari and Globetronics on the fundamental mapper, you will find out that Inari actually falls into what I call the gem common. Reasonably strong business fundamentals, but not enough margin of safety if we talk about trying to invest here. If you talk about Getronics, okay, average performance, okay, cheap enough, okay, but you worry about whether it can continue with its business performance, okay. And I'll go a bit more detail into these companies. Now, Globetronics is based in Penang, founded by, the founder is actually used to work in the electronic semiconductor industry in Penang. Okay, he left the industry, founded Globetronics, and over the past 20, 30 years, he built it up into a very successful business. I think he retired a couple of years ago, and his daughter took over as the CEO. And I will share with you later their performance. But this is a company where 94% of last year's revenue were exported to North America. So very lucky they get an exemption. If not, they'll be in trouble. And what they do is that they focus on manufacturing and testing of the latest electronic products. Okay, so they don't own any of the patents. Whenever the customers develop a new product, they have to develop a new way to test the product because it's a new product. And what happens is that they co-develop the testing with their customers, but the IP belongs to the customers. So this is not a company that actually owns the patent rights now. Okay, but because of the history and so on, they work with the key group of customers to develop the new testing products. Now, Inari, on the other hand, is what I call a assembler. Okay, it's basically outsources assembling and testing facilities. Okay, founded in 2006, 95% of its exports, it goes to a big semiconductor plant in Singapore. Okay, and although they own patents, they are patenting their manufacturing process. Okay, they have a very concentrated customer. Okay, I think 95% of the export to Singapore goes to one customer, reportedly Broadcom. Okay, so if Broadcom's business go up, they go up. If Broadcom business decline, they decline. Okay, very closely tied to Broadcom. Although officially they don't announce, you don't see any announcement of the customer, who the customers are. But I think the unofficial understanding is that it is Broadcom. Okay? So when you look at these two companies in a relative sense, Okay, the columns represents the sector, the median, sector median. The gray line is Inari, the orange line is Globetronics. So you can see that over the past 15 years, past 10 years, Inari business has been growing. Okay, Globetronics not so good. Okay, both in terms of revenue and in terms of profits. Okay, Inari's profits are going up. Globetronics one coming down. Okay, and I'll explain the reason why it is happening at this point in time. Okay, but in terms of margins, okay, both of them do better than the sector average. Okay, so they have good margins. Okay, Globetronics, despite the low profit and so on, they actually have better GP, gross profit. Okay, Inari, because they're actually assembly. Okay, their margin is they're just charging customer for assembly services, whereas at least in Globetronics they develop the testing products and so on. So there is some, I guess, technology element behind it. Okay, so they can have higher margins than basically the assemblers, okay, like people like Inari or even MPI, who are basically assemblers. Now, again, their trend reflects the industry. Okay, so you can see over the past 10 years, the returns have been declining. Okay, and the capital efficiency as measured by gross profit has been declining, even though they are slightly better than the industry average. Okay, they all share the same trends. Okay. And when you look at customer concentration, Globetronics has 2 customers accounting for 72% of the revenue. Inari, like I said, Broadcom alone accounts for almost 90% of the revenue. And one of the problems with the Inari model is that the customers, if you have a customer like Broadcom, they manufacture the end products, your assembly for them. So your job is actually designing and changing your assembly process so that you can actually manufacture the products for them. Now, Globetronics, the customers have the products, they bring to you and say, I developed this new chip or whatever, how do you test it? And Globetronics, what they do is actually they invest in the testing facilities, they develop holders and I'll call it, you can call it testing devices, okay, to test the products. And one of the challenges with Globetronics model is that they must have a roadmap of testing technologies. I think to use it simple, and they have to anticipate what the customers is going to develop over the next 2 to 3 years. So if they anticipate wrongly, and when the customer comes to them with the products and their testing mechanism is not ready yet, they lose the customer. And that's what's happened to Globetronics over the past couple of years, that their product roadmap, okay, has not been matching with the customer's roadmap. So that whenever, for example, if this year a customer comes to you with a new product, your testing devices, your testing roadmap differs from what the customers have in mind. You scramble to redesign your products and so on. And in the meantime, your customers start looking for other places to go and do the testing for them. And that's the Globetronics problem over the past couple of years. It is an R&D problem. It is not, it's an R&D problem because the R&D drives the ability to match their products with the customer's requirements. In the past, at least over the, from 90s to mid 2010, I think like that, they were able to always develop products ahead and be able to match their product development with the customer's product development. They lost what I call this R&D mojo a couple of years ago. And until they rediscover this mojo, I think it's hard to build back the customers. It's a sad thing. It is a tech sector. Technology changes. Products get developed every 2 to 3 years. So if you don't have a roadmap that keeps pace with it, you end up like Intel, you lose customers. Okay, so Globetronics is suffering the Intel problem, that there was a mismatch between product development and what customer wants. You lose customers for some time. Okay, and you hope, like what we all hope from Intel, that they can next batch of R&D that they do, they can catch back and recover. But until they do that, it's very difficult to rebuild back the revenue. Okay, you can see the revenue continue to drop until they get the R&D program back in order. Now, Inari is a bit easier in the sense that they are just doing assembling. Okay, so they don't have to worry so much about coming up to new testing things and so on. Okay, and because of that, they are in a much better financial position today compared to Globetronics. Now, both of them are also benefited from the cash that they've generated, because those days, this is if you have a successful business, it generates a lot of cash, and you use the cash to write down your debt. So effectively, one of the advantages that Globetronics have is that it is debt-free. And I think without any borrowings, it gives them time to rebuild back the R&D effort. Okay? If today they had borrowings, I think they'll be in deep trouble. But because they have zero borrowings, effectively zero borrowings, I think the financial strength gives them time to rediscover their R&D program. Okay. So let's talk about cash. Both companies are cash rich. Okay, I already told you the story. Okay, so in 2024, cash accounted for 44% of Globetronics' total assets. Inari is even higher cash, 63%. And they are strong cash generators. So if you look at the cash flow from operation statement, positive cash flows every year. Okay, it's a cash cow. If you can drive the revenue with the correct products, it's a cash cow. Okay, the challenge with a cash cow is that a significant part of the cash have to be reinvested back into the company, into the business because of the product development plan. Okay. Now, the challenges for the Malaysian electronic industry is that margins have been squeezed. Okay. For those of you in manufacturing, electricity costs have gone up. Okay. We got minimum wage, things like that. Okay, so your margins have been squeezed. Okay. And if you don't control your selling and administrative effort well enough, your margins also goes up. So you can see the problems for Globetronics. Okay, higher costs, higher selling costs as well, not just production costs, and both. So if you imagine, 15 years ago, 2015, they got 30% gross profit margin, 12% selling margins. So 13 minus 12, you got 18%. Today, it is 35% minus 30 is 5% effective margins. So you can imagine the impact of the business. Okay. Now, again, this shows the capital intensity of the business. Okay, because you have to keep on investing in your plant and so on. If you can't grow your revenue, your capital efficiency drops, asset turnover drops, your return on assets drop. Okay. Challenging business. So when you compare these two, okay, looking at top line, looking at returns, looking at financials, I think it is obvious that in terms of top line growth, I would place Inari ahead of Globetronics. In terms of return, Inari, of course, beats Globetronics. In terms of financial strength, I would say they are a draw. Okay, both equally strong financially. Okay, it is just the business side. Now, when you look at valuation, okay, and I do a simple PE analysis. Okay, because of the what I call the fluctuations in the normal course of business, I take the average earnings over the past 10 years as what I call the normalized earnings. So Inari has a PE 24. Globetronics is PE 6, cheap. Okay, but don't look at PE alone, because like I said, this is backward looking. Okay. The challenge with Globetronic is that if they do not solve the what I call the R&D problem, okay, this 7 cents per share, okay, is not going to happen. Inari, I think because of its track record and because of the trend, uh, they may get higher than 8 cents a share, okay, on a normalized basis, okay. Unfortunately, higher multiple, okay. Now you look at the book value, again, I wouldn't look at book value because unless the company is going to shut down and return the money to shareholders, okay, they are all cash rich, unfortunately. As I found out to my horror years ago, the company may be cash rich, but if the company has its own requirements and cannot return it to shareholders, you're not going to get the dividends. So cash rich means supporting the business, but not necessarily good for the shareholders. So if you stand back and look at the valuation and you look at the business fundamentals, I think you can understand why Inari, in terms of business fundamentals, ranks high towards the right, whereas Getronic, in terms of business fundamentals, ranks low. Okay, and you can understand why. Okay, it is just trading at a what I call marginal investment risk. Okay, it's not as if it's in this quadrant. I would have preferred it to be in this quadrant. Then I know that it is actually underpriced. But here, it shows that it's fully priced, if you ask me. Okay. Now, Getronic, the problem is that it is cheap if you believe that it can turn around so that it moves into this quadrant. Okay. But I think the signs are that it's going to suffer for the next couple of years before it can actually turn around. Okay, so it is cheap because it has problems. Okay, and until you can solve the problems, it is something to be wary of now. Okay. So that's basically my take on the semiconductor sector. To be frank, I've invested in this sector over the past 20 years. Gone in a couple of times. I still hold one or two of the semiconductor shares. Okay. If you find a company that is trading at a reasonable margin of safety, it is a good time to go in because this is about the only sector in Malaysia that is not going to be affected by the Trump tariff. And in terms of the demand for AI chips and so on, because of the AI drive, I think the demand for AI, driven chips, okay, especially not just in AI, but also in cars, EVs and so on, we see a long-term trend in terms of the global demand for semiconductors. Okay. The challenge for the Malaysian companies, of course, is that they are not customer-facing. Sorry, they're not consumer-facing. Okay, they are basically industrial. The customers are industrial customers, so their fortune depends on the fortune of the customers. So if today you're a Malaysian company and your major customer is Intel, oh, you got a tough time. But if today you're a Malaysian company and your customer is Broadcom or even Nvidia, then of course you laugh all the way to the bank. So that's the challenge for the sector. Overall, we know that there's a long-term trend, but you got to find out from micro perspective who the customers are and what is their business challenges. Okay? If it's currently stuck in R&D, you're in trouble. Okay? If it's manufacturing capacity one, it's easy to solve because you can actually build plants effectively on quickly. So that's basically my take on the semiconductor sector. For those of you who have not on Sifu, scan the QR code and get it so that you can have a better picture of the investment opportunities in the Malaysian market. All right, that's all I have to say. It is an interesting sector.
Okay, thank you, Dato. So again, for our audience over here or our members over here, do let us know if you got any questions for Dato. So probably Dato can take few minutes to answer your questions. Okay, if you have any. Okay, so if you don't have any questions, once again, thank you for Dato for joining us in this section here. Again, today we do see some a little bit of movement in especially in tech counters today. So hopefully, with the sharing from Dato, it actually give you a little bit more details, uh, or maybe decisions for you to look into what is the next opportunity in these sectors over here. So again, Dato, thank you for joining us, and we will see you again in next 2 weeks.
Okay,
Thank you,
all right.
everyone.
Thank you.
Thank you, Dato.